Good afternoon, and welcome to the session on the future of shale, US and beyond, one of the last two sessions on day 2 of Global Energy Forum at the Atlantic Council. The US shale story has been one of the biggest disruptors of the global energy markets. We've seen production from US shale basins reach 11.7 million barrels per day last year, and the EIA predicts that this year we'll see momentum pick up to 12 or to above 12 million barrels per day. But can the revolution be sustained? Is it sustainable as questioned by the Saudi oil minister? To talk about the shale story, I'm pleased to introduce our panelists. Tom Marchetti, President, Energy Intelligence. Adam Sieminski, President, King Abdullah Petroleum Studies and Research Studies. And Tom Earl, Chief Commercial Officer at Venture Global LNG. We have a few runners just along the sides of the room. So if you have any questions, feel free, at the back of the room, sorry. So if you have any questions, please raise your hands and feel free to question our panelists throughout the discussions. So I'd like to start on a slightly dramatic note and question you gentlemen on whether shale today is the true swing producer in the energy markets. Let's start with you, Adam.
Well, shale is very important in the energy market. Certainly the growth that we saw in total U.S. production in 2018 was pretty remarkable. Keep in mind that a lot of the growth that has been coming from shale includes condensates and natural gas liquids that is not a perfect substitute for crude oil. So that has some issues associated with it. I think what the energy minister said this morning to our group was there's still room in the markets for shale. Demand is growing. Traditional oil production does have a decline curve and has to be replaced. And so I'm not going to disagree with the energy minister that the growth in shale production is not incompatible with continuation of production from the OPEC countries. That both are going to be needed. I think that the real danger point that we would face, is, you know, and this would be a global issue, is if there were to be an economic slowdown of the kind that we had in 2008, 2009. The impact that that would have on demand could be devastating, and the downward pressure that that could put on oil prices and eventually oil production could be a stunning one too.
What are your thoughts, Adam?
No, I largely agree with what Adam said. I don't consider U.S. shale to be a swing producer. It's shortly short cycle, and I would say that, you know, to Adam's point, lower oil prices made the U.S. more resilient on the downside. But, you know, as we move forward, I think people need to be aware that, you know, the activities and the environment that existed in the past is not going to exist in the future. And two main reasons. One is the erosion of quality inventory and resources, because you are depleting high-quality resources, you're moving out to the fringes of the core areas. And the second thing is the access to capital markets and financial availability. And I'll give you some statistics around that. In 2015 and 2016, or 2016 2017, the industry outspent cash flow by 125%. Right? In 2018, you had very much unprecedented growth in the U.S., 1.8 million barrels a day of growth. You had a 20% increase in CapEx, but you spent within cash flow. Right? As you move forward at $50 oil environment, you're not generating free cash flow. Most of the industry under $50 is negative on free cash flow. So what's your alternative? Your alternative is to go to the access capital markets. In 2016, we had a peak access of equity capital markets of $40 billion. Last year, it was 2. Right now, we're less than 5% of the S&P in terms of energy weighting. What do you think it's going to be next year? It's going to be less. So without free cash flow generation, without access to capital markets, where do you generate growth? You don't. So that ability to be a swing producer or really accelerate to have the same type of bumper year you had this year isn't going to exist in the future.
Let me just very quickly add to Tom's comment that to act as a swing producer, in a sense, you've got to act quickly. Certainly, company and government-held inventories can come into the market very rapidly. The spare capacity that OPEC holds, largely in Saudi Arabia, the UAE, Kuwait, can come back in. That does actually take a little bit of time. And shale could act partially in that way, but if you take into consideration what Tom just said, there are time lags available to both pull it out of the market and put it back into the market.
You come from the gas side of the business. What has been the growth story for shale gas so far in the U.S.?
Well, certainly for LNG markets fueled by shale gas, shale has created a really phenomenally exciting, fascinating time for the LNG markets. Shale has helped reduce the cost of LNG on the global markets. The U.S. structure of the gas markets fueled by shale has meant that U.S. liquefaction companies have been able to offer customers around the world a much more flexible LNG product. So that cost reduction and that increase in flexibility has created an environment which has really contributed towards the growth of the overall LNG market, which over each of the last 2 years has increased by about 10% a year. And I think even some of the most pessimistic forecasts for the LNG growth over the next 10 years as we get towards 2030 is about a compound annual growth rate of around 4 to 5%. So a tremendously exciting environment, very constructive environment for LNG, which has been helped a lot by shale. It's not only the supply side where shale has dramatically affected the supply of LNG, where the US really has to compete against the equally or very low-cost resources in the Middle East and Russia, for example. And we see an environment where there is an increasing trifecta building for this increasing LNG demand as we move towards a market that's 330 million tons today, up to around 600 million tons towards the end of the next decade. But there is the supply side and the advent of shale has enabled lower pricing, a different pricing for LNG to be priced as gas rather than LNG to be priced as oil. Customers find that very attractive, and that flexible product, which enables the customers to divert cargoes as their demand needs change. And the confluence of that supply side with the demand side, which has already been spoken about very well over the last 48 hours, as it were, the increased demand in LNG from China, from Southeast Asia, and perhaps the less well spoken about aspects of Europe, where you have a very declining production environment in places like Groningen, for example. Again, add a constructive environment from the demand side for LNG. And then you have the technological side, or the innovation side, where you have almost 30 FSRUs in operation around the world, which have slashed the cost of regasification terminals down from $1 billion, simple numbers, down to $300 million. And we've seen the number of importing countries go up to around 40 countries from about 10 years ago. So that innovation, alongside the confluence of the supply side changing, the demand side changing, and also now the emerging innovation, which is modular, factory-built, liquefied gas trains, which are lower in cost to build, they're faster to build, they're in controlled factory environments, and the emergence of those modular trains is decreasing the cost as well. But shale certainly has created the environment and the catalyst for this lower cost and more flexible LNG environment. Swing, I'm not sure, but certainly has helped create this incredibly constructive growth environment for LNG.
The Saudi oil minister earlier today mentioned that they have sufficient resources following the independent audit to replenish barrels for the next few decades. Was there some sort of subtle messaging that even though shale has proven to be has outpaced Saudi and Russian production. Is there a subtle messaging from the Saudi oil minister that even if you're able to match production, we still have the lowest cost barrels, we're still able to bring in conventional production, and we still have the resources available to do so?
I think that would be a great question to ask the minister. CAPSARC is an independent research institution, think tank. We're not part of the government, and we don't speak on behalf of the government. And I don't speak on behalf of the energy minister or anybody else in Saudi Arabia other than CAPSARC. I'd say that in general, the resource base in Saudi Arabia is very strong. And part of that message, I think, has to do with, and the costs are very low, and that whatever happens to demand for oil looking out into the future, the Kingdom of Saudi Arabia will be playing a strong role in providing oil into those markets.
And there's also an argument that all shale is not created equally, and shale production is more of volume, quantity over quality, and that the kind of crude that you see from the basins is of a lighter variety, and you might hit a refining wall given demand for gasoline and diesel in emerging economies and demand for a heavier version of crude. Is that a cause for concern in the surging production that we're seeing in the US today?
Yeah, I mean, our forecasts right now show that the incremental growth that comes out of the United States for crude oil is going to require that 60% of that demand is satisfied by the global market. You know, we talked about some of the milestones that you're going to probably hit in 2019. You know, global U.S. refinery capacity hit 18.5 million barrels a day. It's still only at probably 91, 92% utilization, so there's still room to the upside. But by 2020, 2021, you're going to hit a wall in terms of how much ultralight crude capacity you can refine. It's going to be largely dependent upon the ability to access global markets. Now the question is, where does that crude go? What does that crude displace? At the moment, we see most of those opportunities being in Europe for export markets. It's a good product to blend with heavier crudes, Urals. You know, there's some opportunities, probably a little bit more limited in Asia, but you're going to have to find and create new international markets because they're simply running out of opportunities in the United States.
What are your thoughts on it, Adam?
I think you should move on to that. I think that answer was perfectly sensible.
On to gas. I wanted to know what sort of demand you're seeing from Asia for US LNG.
Strong. There is an increasing pattern. The data points are in the deals. I think we were in an environment only 2 years ago where many analytical elements of the market were saying that long-term deals are over. We're moving to a very short commoditized market and so on. The Asian part of the market is still looking for long-term contracts. I think between Anatol at Cheniere and ourselves at Venture Global, I think about 12 long-term firm LNG contracts, SPAs, have been signed over the last 18 months. And some of those are in Asia. I think the latest one, the Cheniere one with PetroChina, will be evidence of that. I think there's a lot more to come. I think the pockets of demand, it's not only the well-known story of policy-led LNG growth in China as they pivot away from coal. There is other substantial pockets of demand, like Thailand, for example, where indigenous pipe gas production is in significant decline and needs to be replaced by LNG. And there's very substantial work programs afoot with regasification terminals or increasing existing regasification terminals. There is new pockets of LNG from non-existing buyers, such as the Philippines, for example. Same indigenous gas pipe issues of declining indigenous production. New markets like Myanmar, for example, Vietnam. So I think Asia on that eastern side, and then of course there's the recent programs over the last couple of years from Bangladesh, Pakistan, and India. Just in the middle of last year, India's demand for LNG was around 28, 29%, I think, in Q3, year-on-year higher for LNG. And India is certainly shows signs of huge mobilization. There's new regasification terms. So I think in India as a whole, Asia as a whole, there's a very constructive environment and a demand for US LNG. It will not be it will be done, I think, in proportion. So I think the portfolio buyers appear to be looking for a share of their portfolio to come from the US, as the US occupies an increasing share of the global market that will extend towards 25, 30% of the global market. They're looking to replicate that in their own portfolios, and you see that happening. The evidence is in the deal. Look at the recent deals where they're looking to put 25 to 30% of their portfolios on to Henry Hub US-based LNG supplies.
And within the US, has export capacity kept up with the shale gas boom?
To an extent, yes, and I think it's iterative, isn't it? Because the growth markets for gas in the US are really largely limited to LNG exports. The power sector is not growing. The domestic use of gas is not particularly growing. And so the LNG exports are the answer to a lot of this increase in shale gas production. The two need to match. Of course, they don't match year on year, and therefore you get some dislocations that the US is very good at. The capital markets of the US and the innovative infrastructure companies like Kinder Morgan or Enterprise Products, for example, link those via deploying capital into pipelines and infrastructure to make the two meet. It's not always perfectly on time, but I think in the US what the evidence has shown over the last 5 years since the first wave of LNG that they do meet, if not exactly at the right time. Given that we're dealing with 20-year contracts, 20 years investments, they do marry up, and so I think they do. I think the answer to your question is yes, they do.
There is some need for gas, shale gas, and the light ends from shale oil for the petrochemical business in the U.S. and particularly down in the Gulf Coast area. So and I agree with Tom that the power market is really going to be dominated by renewables over the next 10 years and not so much gas. There are other industrial uses for natural gas besides chemicals where there could be improvements in the markets, but a lot of the gas production is going to go out as LNG. I guess the good news is basins like the Permian and Eagle Ford have a lot of gas, and so the opportunity set for that being a continuing sustainable business is very high.
And Tom, you mentioned earlier that the demand for shale, for lighter crude, will mostly be seen in Europe. Do you see U.S. shale going into other export markets, in Asia, for instance?
Yeah, I think I addressed it in the last one. We were talking, when I was specifically talking about the European markets and also a limited supply into Asia, so not to be too redundant about that. But maybe a point going back to the last point on LNG. We have 70 metric tons of potential projects coming online for next year for approval. We certainly think that the U.S. market is not going to be as reliant or a need for exports. We think there's enough demand on the U.S. It's certainly not facing the same challenges that crude is. But just one thing to think about, and I think certainly slips people's mind on occasion, is the potential for revival of domestic exploration projects. I mean, you think about Chevron going back Bangladesh, Exxon in Pakistan. So to the extent that there are, other IOCs and NOCs that are interested in revitalizing their domestic gas programs, it is something that could kind of crowd out some of the demand for LNG specific delivery. But we think those are things that are more on the margin, but I think it's just interesting to note.
You spoke about modular technology and how it's impacted the LNG markets today, the sort of plug and play that you mentioned earlier. I just want to gather your thoughts on how the financing needs for this particular segment in the US is being met today.
Well, I don't think I think the financing isn't necessarily changed by the specific technology. I think there has been, even if they've been relatively subtle, there's been a track record of modular per se in oil and gas before, and LNG before. I think the fabrication yard that we're using with Baker Hughes in Italy is a Massa Avenza is a fabrication yard that has a track record, for example, in producing modules for Yamal. They were produced on time, on budget, and they helped Novatec and Total deliver a very rare highlight of the industry, if you like, of being on time and on budget. And part of that had to do with the modular nature of those of that project. They had to be delivered in a very narrow weather window in the Arctic, and that drove the need, if you like. And now, what companies like ourselves are doing is taking that model and replicating it or adjusting it and improving it. And so I think there's enough of a track record where I think the finance community are embracing it. I think they love the idea that of the control that it puts back in the hands of the projects, because the modules are created in a factory environment where you can really control the schedule much better. You can divide, at least in the field, the workforce by 4. You can cut 25% of the time schedule that it takes to build liquefaction projects. And so there's those things which play into the financing. But I think the signals look good. We need to wait a little bit longer, but to see these projects come to fruition. But the signs are good.
And what sort of impact have the tariffs by China on US LNG had on the long-term view of the market?
Not much so far, I think, is the answer. I think the LNG being a fungible product per se, and it's got increasingly fungible and tradable over the last 5 years. There's plenty of good data on that. I think what China perhaps has avoided to import, even though I believe they've imported 1 or 2 cargoes directly from the US and just paid the tariff. I think CNOOC has done that. Or one of the other NOCs perhaps, but even if not, the market is so active in terms of the ability to swap and create physical swaps that I think the tariff itself has not affected the physical spot trading market or the overall. It hasn't affected the overall demand of the market, and I would say in that environment with China and the US has not stopped any of the work product and the number of people working on LNG contracts and so on. The work has gone ahead just at the same accelerated pace than was going on before the middle of last year when this environment was started. So no, I don't think thankfully we're in an environment where that's affected things very much.
Has the trade war had an impact on the outlook for US shale cargoes to Asia, for instance?
I mean, China was importing excess of 600,000 barrels a day in December or in June of last year. In December, you're down to less than 10,000 barrels per day. So it certainly had an impact. But I think you look at the trade negotiations right now. U.S. energy policy is not aligned with trade policy. The U.S.'s interests and China's interests for trade are at risk right now, and I think both parties understand. We don't expect an immediate resolution, but we do believe that there's going to be very positive and constructive agreements met in the near term. There'll be the building blocks, but we think that the circumstances right now are too dire for both economies that they have to find something that's amenable, and they will do so. And I think that there is going to be increased demand in going into China. I don't think it's the most important thing that they're trying to solve on the trade negotiations, but it's certainly an important element of energy security for China itself, and we're certainly more than capable to be able to be supplying it.
My concern about the trade issues is that concerns about the outlook for trade would erode consumer and investor confidence, and that would lead to a slowdown in spending and investment that would then slow down GDP, and so that the effect would really be more not the specific one that you were asking about, but more of a general impact on demand that would be a concern for everybody that's in the energy supply business.
We have a question from David.
Yeah, maybe why he's lining up for his question, because I know he's gonna have a pretty big interlude to it. So I mean, I think most I think most Wall Street analysts probably were looking at growth next year, ratcheting down probably by at least 300,000-400,000 barrels a day. And to Adam's point, I think most of that reflects, you know, a tightening in demand concerns.
Thank you.
So my question, very simple. Could you talk a bit about the beyond? You've done a lot. You've talked a lot about the U.S. shale, but can you talk about beyond, both geographically and in terms of time? You know, looking forward 5-7 years, what does it look the same as it does today, and also where else might it look?
You want me to start?
Go ahead.
I mean, listen, Argentina is doing well right now. You know, it's a slow process. It's smaller applications. And listen, the United States had a very unique opportunity because it had an ecosystem. From the education and very strong school of mines to very strong resources. And most importantly, isn't really the technology, although I'm not trying to dismiss that, but technology is exportable. What's not really exportable is the real ecosystem that's developed, and a lot of that is logistics and supply chain management. And that's where you really see the efficiency. You know, if we talk, like, you know, VG LNG, what have they done to really change their approach for LNG? Shifting down the cost curve has been the most important thing. And the success of shale, we're talking about dispatch, right? It's not the cheapest oil out there. The only way you do produce it is you lower the cost curve. And what the U.S. has been very successful at is lowering that cost curve, but most of that has really come through logistics. So you think about other opportunities around the world. Well, obviously the Middle East does have its fair share of shale. The technology is exportable. The resource is present. Labor, logistics, supply chain management still present issues. It doesn't say that it
water.
What?
Water.
And water, right? Those are all parts of it. I mean, all those type of things in the supply chain and integration make a very big difference in the cost curve and making, you know, higher cost items like shale economical and, you know, viable to compete with other sources.
I would say the hope of replicability has not been met by the actual replicability. That when I think back to my days of working in the Barnett and with teams of Aubrey McClendon and so on, and there was a lot of thought going into, well, this can be replicated in Vaca Muerta, and can be replicated in China, and can be replicated in Europe. And you think back to, I mean, I think in the UK right now, I think we have one well and the barriers in the UK have been the environmental concerns of the people around and the incentives being misaligned or not aligned in the same way as in the US, where everybody in the same ecosystem is somewhat sharing the benefits of the wells. But I'm not sure I see shale per se, the replicability, increasing yet in the next 5 to 7 years. There's a tremendous amount of work, as you know, I think David more than I, on the Vaca Muerta, and but in China it's been being tried for a long time and still not advancing.
Tom mentioned Argentina, the Vaca Muerta. I think in China the problem it's a combination of issues, but the geology has turned out to be a lot more complex in China than people expected earlier. Canada's had some success. There's actually shale gas being produced in Saudi Arabia from the Jufara Basin, but it's kind of let's have a look at it kind of thing. I think that in many places like Russia, for example, that has significant shale resources, both oil and gas, the traditional, conventional resource base is so strong that moving to higher technology shale production isn't really necessary. There's been some experience in Australia. So there are pockets of activity in different places around the world, but the real heart of shale, both oil and gas, is still in the United States.
Unconventionals have joined the narrative of Middle East energy last year. Bahrain announced 8 billion barrels in reserve of shale oil last year, and ADNOC, Abu Dhabi National Oil Company, has said its intention is to develop uneconomical gas reserves here in Abu Dhabi. Has the time arrived for Middle East fracking? I mean, do you see any synergies between US shale drillers and national oil companies here in the Middle East?
Are you asking me?
Happy finding time.
You know, it's there is a really interesting thing, and it's worth thinking about, actually. There are often different countries that come to the United States. When I was heading the Energy Information Administration in Washington, I'd often meet with delegations that said, we'd like to have access to some of that really inexpensive natural gas. You know, it's like, can we have $3 gas? And what my answer was is, well, first of all, the U.S. government. So coming to the U.S. government for that purposes doesn't really make a whole lot of sense, because for the most part, the government doesn't own any shale gas. Shale gas is owned by individual, farmers and ranchers and companies, and you would be quite welcome. Anybody, national oil companies or national governments would be welcome to come and make a deal with any of the companies in the United States that are involved in doing that. There isn't anything that would stop them from doing so. But the idea that there would be a government-to-government deal is something that I think probably has pretty low chances.
What are your thoughts on it?
Well, I think it's somewhat the same point that Tom was making about it's not only shale, it's the investment or in new gas programs, the advent of new gas programs in places where the indigenous production has been falling. What's the potential to increase gas production? And the licenses here awarded recently are an example of that. And I think that shale outside of the US is one thing to look at, and the replicability of the US. But I think, as Adam was saying, it's so specific to the geology, and the surface conditions, legal conditions, and so on, that it's a case by case basis. But the other aspect of that is that there is still huge ongoing programs which are non-shale related that are arguably far more competitive again, in Russia, for example, where production basins are being bought on or gradually being bought online, which are highly competitive. Papua New Guinea, for example, and another example, which will produce competitive LNG as well, competitive gas as well. So replicability of shale is one thing, and unconventional deployment of capital into unconventional resources in areas like the Middle East and so on is fascinating. But there is also the potential to be producing a lot more gas that can compete against the US shale from other areas in the world, whether they be in the South American offshore basins or Gulf of Mexico or in the Middle East.
We've also heard a few Middle East companies like Mubadala express interest in developing shale oil and also invest in LNG facilities in North America. Are we likely to see a pickup in momentum of investment flows from the Middle East into shale oil and gas in the US?
Tom, what do you think?
Yeah, I don't know about that one.
I think the answer is yes. Sorry, were you going to?
No, go ahead. Which either.
I think the answer. I'm fascinated by that, and I think the answer is probably yes. I think there's a certain logic to that redeployment or diversification of expertise that's here and deploying it in not only the US, but the US can be part of it. And I think already the Middle East has a great track record. If you take America, for example, not only the Motiva operations, which are world class on the Gulf of Mexico of Saudi Aramco, but if you look at the investment of Mubadala through Nova Chemicals into the Port Arthur ethane cracker, which is using shale ethane from the Marcellus, shipped down a pipeline all the way to the Gulf of Mexico. This is a world-class investment by Mubadala, and so you could argue that it's already started, and it started some time ago. And I think it's just a case of individual examples that fit the strategies of individual Middle Eastern companies. If the opportunities are good enough, maybe the news is right. Maybe the journalists are right that will be the trend.
You know, you did hear actually earlier Tom Marchetti say that that he was concerned about the availability of capital for shale development in the United States. There's a lot of issues surrounding that. So it's certainly possible that foreign capital could come into that business. I think it would depend on what foreign investors felt they were going to get out of that. You know, was it access to the technology, or were they just looking for a return? And if they're just looking for a return, maybe there is something else to do that's not shale.
Yeah, I mean, listen, the approach that the United States has been forced to take is very much bifurcated. If you started 2018, the beginning of the year, 20% of production is by the majors, low 30% is by the U.S. independents. If you took the Wall Street estimates at the beginning of the year and look at 2018 actual production, it was very much close. But nobody expected 1.8 million barrels a day of production out of the U.S. So where did it come from? It came from the private companies, private funds, foreign investment funds. They're driven by different motivation. There's different strategies. Some of them are learning experiments. But I think that longer term, you know, there is going to be a need to be focused on returns for individual investors. That's what they're requiring. But there's also a need for cash flow, for production, for energy security. So I think they can coexist.
And in terms of profitability, we've seen the U.S. president push for prices to go lower. He tweeted in late November that the low prices were a tax cut for America and the world, and he wanted the prices to go even lower. What has been the sort of impact on the profitability of U.S. drillers because of the messaging from the U.S. government?
I'm not sure I got that.
What sort of impact has the president's tweets, for instance, had on had on the drillers in the U.S.?
On the drillers, I would say none. I don't think they pay that much of attention to it. I mean, the president's policy is very much in favor of jobs. It's very much in favor of, you know, making America great. Part of that has to do with energy security. Part of that has to do with the production growth profile that the U.S. has become more independent and using that as part of trade policy. You've seen that integration. But in terms of his direct impact on drillers and their decision making, I would say it's none. But you know, we had a fun session last night talking about Trump and his tweets. And so maybe I'll paraphrase our hour and a half of closed.
Chris and David are cooking up some nasty questions over there. Let me just jump in and say that along the lines of what Tom just said is that there is one area, the kind of pullback in environmental activism on the part of the White House now, I think has created some opportunity set for the companies. But it's really kind of interesting. There are a lot of things that the companies are going to do that really don't have that much to, that they are going to take certain actions in the environmental area, controlling methane that they feel is just in their own interest, whether the Environmental Protection Agency has a new set of rules on that or not.
I mean, they're fun to look at. They're fun to look at in the coffee break, but then we go back to work. I think
Sure.
I mean, genuinely. I mean, well, maybe we look at Brexit too in the coffee break, but then we go back to work. Get on with the job.
Yeah. But on a serious note, I would add though that what is unprecedented about the president isn't his tweets. It's the fact that he is interjecting his opinions on policy into the market on a daily basis and interacting with it. So as we talked about last year, if you kind of frame it, if there's a certain amount of variables in the market, you're now inserting another variable. So that provides greater amount of uncertainty, greater levels of variability, and what it's doing right now is creating greater levels of volatility. We believe, broadly speaking, that over time, that volatility will erode because I think the president is being more transparent. I'm not saying the message is the right message or the wrong message, but it's consistent and it is providing more transparency. And over time, the market will learn to adjust to that. It'll become more efficient.
Chris Mitchell, S&P Global Platts. Assuming there is no capital limitation, we know there's not a resource constraint, and assuming that price is, let's say, above $70, just to make life easy for you, how high do you think US shale oil production can get to? What do you think the level it can get to? And what will be the constraining factors that limit it getting higher?
So in the beginning, the two constraining factors I was talking about was the deterioration or erosion of quality resources. That's something that we think comes into play, but on a slower basis. I mean, before we start to deal with China and trade balances and global risk, we were thinking that was probably a 2021, 2022 event. We pulled that forward. 2019, we originally had growth projections of 1.2 million barrels a day. We're pulling that down under 1 million barrels a day. I think that the growth rate is going to moderate. It's going to moderate at an accelerated pace. 2019 is not going to change much. 2020, we'll see a much more dramatic drop off in capital spending.
I think that the infrastructure is the key piece, or a key piece, and there are a phenomenal amount of pipeline projects in planning which are a key piece of that key piece, if you like, both on gas and crude and products. What the Kinder Morgans of the world and the enterprise products of the world and so on are very good at is identifying, and indeed the traded market of the US gives the price signals very starkly that enable perhaps those investment decisions in the infrastructure to be taken more visibly, more easily, and the capital very quickly follows the plans of those companies to link the constrained markets with the demand centers. And where those prices become dislocated, I think the track record of the US is that prices don't stay dislocated for very long before infrastructure projects come in, of course backed by credit-worthy, often 20-year take-or-pay contracts which secure the investments into those infrastructure projects. But that's one of the main areas that the focus will be on in terms of increasing the ability of the US system to increase its production of products and natural gas.
So
I was just going to say, just speaking to the infrastructure point, we do. I know, I'm getting in there. I'm starting to do the same thing you were doing. But I
can't remember his question anyway.
Are you guys looking for me to jump in here? Is that the thing? EIA has modeled this. CAPSARC has taken a look at it through some other. We have some people working on this, but we also have other consultants and outside people that look at it. And what I would say is it all depends on the price, Chris. So if you're talking about a $40 oil price, you're going to get less than you get at 60, and you're going to get more at $80.
He did say 50.
For shale. You did say 50?
Oh, 70.
70. See, I didn't hear that part. 70, and you would still grow it. I mean, I've seen numbers, and this is from EIA, that everybody's kind of thinks everything is going to slow down kind of at current prices, and let's say current prices 60 to 70, when you get to around 2025 or so, and then it begins the growth rate slow. I think that depending on the technology, that it could still go out. I've seen some estimates that say total U.S. crude production, so black crude production, 10 million barrels a day now could be twice that in 2030 if under the right circumstances. And all of that growth would probably be coming from shale. So, and shale currently, and it's really hard. I mean, one of the things you want to keep in mind is knowing how much oil is shale oil is not easy. EIA has spent a lot of time looking at this. You can measure what's coming from the shale areas, like the Permian, 4 million barrels a day of output from the Permian, but maybe only 2.5 of that is shale, and the other 1.5 is conventional crude, and so you're always kind of mixing things around. But the numbers could go up. The other thing that I think is a huge unknown, and we've talked about it at the edges here, is the technology. The recovery rates for shale oil and shale gas in the United States, where you have the most experience with it, are still pretty low. I mean, you know, like they're single-digit numbers, percentages, or low double-digit. By low, I mean 11 or 12% kind of recovery rates. It's not anything like the 40, 50, 60, 70% recovery rates that you get for traditional reservoirs. And so the opportunity for somebody to come up with some kind of change in technology that improves that number exists. And that would make a very dramatic difference, because if you look at one of the other things that EIA and the U.S. Geologic Survey has looked at is there are a lot more potential gas basins in the U.S. where shale gas could be available than there are oil basins.
Right.
And once you go through the Permian, and that's why everybody is thinking by the mid-20s why things might plateau off, you're going to need that breakthrough in technology, because it's not clear that there's another Permian that you're going to be able to go to lift the numbers.
I mean, I know the more interesting part is the oil part, but as the poor younger brother on the gas side, I mean, the gas environment with a gas, you perhaps an equivalent on the gas price to a $70 oil price. If you have a $3 gas price, even the dry gas basins, and this is being proved up day by day in the Haynesville, for example, the volumes of gas that are possible and profitable at $3 are phenomenal. And the data sets that are out there from BP and Shell and Chevron, for example, of what's producible at that kind of price is phenomenal. It's just the infrastructure that's needed to link those with the export facilities.
We have a question here.
Yeah, I'm not sure if you have much time left, but just a question on the price of money. The shale boom has come into the world during a period in which money has essentially been free, and now we're facing a somewhat return to normalization of higher interest rates, etc. There's been some analysis that would cap the potential for shale. What's your own view on that looking forward? If we do continue to get to normalized interest rates, does that have any downward pressure on the growth potential of U.S. shale?
We definitely assume that. We believe that there's going to be continued downward pressure on it. It's becoming much more of a manufacturing environment and more less opportunity for differentiated returns. I think there'll be more less advancements on gathering resources and more advances on the development of those resources and the manufacturing of those resources. And if you look at the valuations for those type of business models, they generate lower returns and they have lower multiples. And associated with that, it's going to attract less dollars. So I think capital markets are going to be restricted to that, and you're going to have lower amounts of allocations going after those type of activities.
I have just a slightly different take on that. You know, having looked at capital formation issues over most of my career on Wall Street, what I would say is that if the returns are available, the capital will flow to those returns.
Right.
And that thinking about limitations on capital, that's true when the returns are getting close and the opportunities for investment to go elsewhere is similar. But if because of technology or because of the demand for natural gas on a global basis, if it's strong enough, my guess is the money would flow to make it happen.
It depends on your outlook for price and for returns. Right. If you're thinking about a $100 environment, and the costs aren't going to be $100, costs don't have to follow up, because you have to develop either a way to lower your cost curve, or you have a way to, say like Adam was talking about, increase your recovery factor, something that changes the business model that really. You've had a decline and a contraction in margins. You'd have to change that trajectory.
The problem we found with the $100 environment is if you have that long enough, you begin to constrain demand, and then that leads to the erosion of those returns. Yep. So it's as Tom said, it's a return issue.
Lastly, is the view of the EIA that shale could surge to beyond $12.2 12 million barrels per day. Is that a realistic one in the current price environment? I'd like to start with you, Adam.
In what environment? I mean, yes. I mean, what I said is you could have, if there's 7.5 million barrels a day of shale, of oil production coming from the shale basin areas now, getting to 12.5 million barrels a day is no problem at all if you have the right conditions in place to do it. The resource base is there. So I think that what we're always facing is and it almost goes back to your question about Saudi Arabia. The resource base exists in Saudi Arabia. The resource base for shale exists in the United States, and it's really a question of what does the market look like for consumers to want to use oil in a sustainable way.
Thank you. Any more questions from the audience? Yes.
In 2014, they said the shale oil 1. 2 years ago, they said shale 2. And it has to do with the prices from $70 break even to 45 to 50. Now, what's like the break even cost for shale oil and the future of the rig activities?
Yeah, let me, that's a really easy question to ask, and it's a good question, and it's a really hard one to answer. And let me explain why. Because you've got short cycle, mid-cycle, and full cycle issues, right? So what you can do in over the course of a year is one thing. What you can do if you're trying to price in the above cash costs, and what you have to price in if you're paying for everything, the land acquisition, the geo engineering, and all of the taxes and so on that go with that. So the break-even numbers depend on whether you're going to talk about cash costs or the full cycle costs, just as an example. And then they depend from field to field and tax regime to tax regime. So ultimately, I think that what people right now seem to be narrowing in on is that $40 is too low, $80 is too high, and something near $60 or $70 might be the kind of number that makes sense in the near term. But all of that is going to depend on a lot of other factors that enter into the marketplace.
I would add a little bit to that, because I tend not to think about break-evens, but think about dispatch, because it's if you have 1 million barrels of supply and you have 1 million barrels of demand, your break-even might be X. But if you need to go up 200,000 barrels additional, that might be $5. But if you have to go through another 100, well, to bring on those additional resources might be $10. The curve is not linear. And I think when you think about break-evens, what I would say is the curve went from being very steep, because we've had a lot more technology and a lot more delineation of the resources. The curve is flattened out a little bit, but you still do have to think about things in terms of dispatch. And if we do have increased demand and bringing on those resources and the quality of it, it's still going to require prices moving up. It doesn't, we may be at price equilibrium from a certain demand growth right now at $50, $60. Million and a half barrels of demand, when you're still facing unmitigated declines of 3 to 4% globally, maybe that is a $70, $80 plus number. And I think that's the real question. It's not just break even for a certain price point, it's the dispatch.
Thank you, gentlemen. For more thoughts and for more insights, please refer to the Atlantic Council's report, The Future of Shale, US and Beyond. It talks about the history, the present reality, where shale's headed, its replicability. It's on your app, which you can access. Thank you again for your time. I now welcome Randolph Bell, Director, Global Energy Institute. Hi, Randy.
Thank you, Jennifer. Thank you so much. Thank you, Tom and Adam. Really very much appreciate it. And Adam, we really appreciate the partnership with CapStark. That's been just so helpful over the course of the past couple days. This is the paper that Jennifer just mentioned, The Future of Shale, the U.S. story and its implication. There'll be copies on the way out the door, so I hope you pick one up. It's a really great paper, and unfortunately the author, well, fortunate for her, Ellen Scholl got into the Foreign Service, and so can't be here today. She was originally going to be on the panel, so she is now in training to join the U.S. Diplomatic Corps, so it's great. But it's a really good paper and the beginning of a longer effort on the future of U.S. shale and the internationalization of shale. Thank you all for sticking with us for the past 2 days and a long couple of days, but I hope we're incredibly interesting, thought-provoking, and ultimately will help you make better decisions over the next year. I haven't been out here much today because I've been in back-to-back meetings with a number of our stakeholders already talking about what the Atlantic Council's research will look like over the course of 2019 and what we will be doing here in 2020. Some of the ideas include hydrogen in China, the possibility of international cooperation instead of competition on next generation nuclear technologies, and then a more expansive geographic focus on Asia, East Asia, Southeast Asia, South Asia. You're going to be hearing from us in the next few weeks and over the course of the next couple months, looking for feedback on the type of work we should be doing, what will be helpful for you, what will bring you back here next year, and make this an even more impactful event. It's fitting to end the evening with a panel on one panel on U.S. shale and then one panel on the future of OPEC. Together, it is the issue that is perplexing markets for a few years now. With the two people who are about to join on stage, you will see what they think the future of OPEC and their non-OPEC partners are, and their decisions and efforts over the next year will be incredibly important for markets, for energy security, and for the global economy, not just for 2019, but for years to come. So thank you again for joining us this weekend. I want to thank our partners, in particular the Ministry of Energy and Industry, Mubadala, ADNOC, Masdar, Crescent Petroleum, Etihad, our knowledge partner CAPSARC, the international media partner CNBC, and the World Energy Congress, which is here in September. And I hope you all come.